Hi, this is an audio to go along with the email. You'll notice an image attached, and I will be making reference to that image shortly. So the title of the email refers to inflation being mentioned by a mainstream media source as the cause of gold prices falling, as well as the fact that gold prices rising is frequently referenced by the media as being caused by inflation. So in the article link below, probably in blue text for your link there, the media uses the same cause to explain gold prices falling as has been frequently used to explain gold prices rising. Isn't that at least slightly odd? It's kind of like saying that burning more wood in your fireplaces causes the temperature in your house to rise, but burning more wood also causes the temperature in your house to fall. So there's the article, or there's the link to the article. By the way, inflation both causes temperatures to rise and to fall, right? Note that many competent, accurate forecasters have been concluding that in places like the US, UK, and EU, inflation is not the issue. It's not the issue, and in fact not an issue at all. However, the media is focusing a lot on inflation, so shouldn't you? Well, the media is also using the demonic evil of inflation to explain gold prices falling, like today, as well as gold prices rising. So consider that the financial media may have no credibility. They may be slightly influenced by the advertisers and shareholders who pay the editors to publish the confusing interpretations, perhaps designed to confuse as many people as possible about some really quite simple stuff. But wait, hasn't the mainstream media consistently offered you relevant advance warnings of the major financial developments of the last several years or decades? So when the PR engines of the Federal Reserve tell you that they are very concerned about inflation in the future and they are fighting inflation tenaciously, like because they love you, because that's what's good for you. Are you thinking of the Federal Reserve as responsible, like when their PR engines tell us all this stuff about inflation and so on? Are we thinking of the Federal Reserve as responsible for our financial futures, as if the Fed is both competent and personally loyal to you personally? Consider instead of the massive waves of the writing off of bad debt or unpaid debt, accounts receivable, also known as credit deflation, have been driving down prices in real estate and stocks in Europe for many years, in Japan for over 2 decades, and in the US to a somewhat lesser extent in the last several years. Massive waves of the writing off of bad debt have been driving down prices. Why? Well, these waves of write-offs are like ocean waves, slowly but surely melting the sandcastles of prices in the housing market and stock market, wave after wave after wave. The sandcastles get smaller and smaller and smaller. Following decades of easing in credit markets or lending, the progressive massive undervaluing of cash finally has reversed, like a shifting of the tide. Even in the US, it's reversed now, not just Europe and Japan. Um, so there's been decades of easing in credit markets leading to a massive undervaluing of cash, or a discounting of cash. When we say undervaluing, that's already interpretive, but it's a discounting of cash, meaning an accounting of cash as less and less valuable because there's been easier and easier access to more and more credit. So as people stop thinking of credit as easily available, like for real estate purchases, then each cash dollar becomes more valuable to them. It seems more valuable to them. Just actually, it's supposed to say becomes less valuable. I'll change that. So the more access to credit people have, the less valuable each cash dollar becomes. So the poorer someone is, like the less income they receive, the more conservative they are with each dollar, valuing the cash more because they have less anticipation of future cash available through income or through credit, through any means. The less future expectation of cash they have, the more conservative they are with each uh, dollar of cash or yen or euro of cash that they already have. Similarly, the less of a credit line that someone can access, the more valuable each cash dollar is to that person, including decision makers for organizations. So we're not just talking about husbands and wives and mothers and fathers and grandparents and all that. We're talking about businesses and governments and churches and so forth. In contrast to the mainstream media and most financial professionals, many people, including me, forecast years ago that households, businesses, and governments around the world would be facing budget issues due to a cluster of related developments. In 2003, I reported that credit markets had already started to shift and destabilize globally, like the tide was showing signs of turning, with each new wave of credit inflation producing a smaller movement up the beach. Visualize that. The waves come, more and more credit inflation, smaller movements up the beach. The tide's turning. Soon the tides aren't going to reach as far up the beach. The waves aren't going to reach as far up the beach. The tide's going to start to move out. In 2004, I publicly identified an emerging global oil crisis as the primary fundamental economic issue behind the already evident credit crisis. In 2005, and then 1999 was kind of the turning point in year in regard to oil, as well as the U.S. Treasury market. Maybe those are not just a coincidence. Anyway, in 2005, I published a very simple set of facts clearly establishing the functional prominence of oil and the near irrelevance of the now rather minor market of gold, which has no major primary economic function. Here's a very, very brief summary of the 2005 article. Gold is primarily a store of value. This is not really an accurate summary of that article, by the way. If you want to see the article, I'll be happy to send it to you. But for dramatic purposes, gold is primarily a secondary store of value, like paper currency or accounts of electronic credits, like a plastic card that is an account, a debit card, a EBT card, ATM card, all that kind of thing, credit card. In other words, gold is money, merely money. Oil, however, is actual energy. It's fuel. Money is a symbol or a symbolic representation of the capacity to do work. Oil is the actual tangible fuel capacity to do work. Anyway, I titled that article in 2005, Worth Its Weight in Oil. This week I'll be launching my new website this weekend, thedominoileffect.com. In it, I will probably say virtually nothing new for people who've been following my material for a while. However, I'm constantly simplifying my presentation format, so attached is an image I recently made that presents a memorable reminder of a very simple logical sequence. 1. Oil prices rise unexpectedly, causing 2. Gasoline prices to rise unexpectedly, causing 3. Total spending to rise unexpectedly, at least for gasoline-dependent people and organizations. As oil prices go up, that leads to gas prices going up and total spending to go up if they're using the same amount of gas or just about the same amount of gas. And gas prices go up, then their spending goes up, causing, number 4, many people and organizations to have less extra cash remaining than expected after the increased spending on essential fuel expenses. Causing, number 5, many people and organizations to unexpectedly use less cash for investing, like in stocks, or lending, like to finance other people's speculative borrowing in real estate. They have less money available because they've spent it on more of it on gas, so they use less to invest in stocks, or to lend for other people's speculative borrowing in real estate, and so forth, causing number 6, declines in purchases and prices of things like stocks and real estate, all very unexpectedly. Note, of course, that the word unexpectedly is inserted for people who have been investing their attention and financial futures in the questionable effectiveness of folks like the mainstream media. Then again, consider that the mainstream financial media may have been extremely effective in advancing the short-term financial interests of their advertisers and shareholders by confusing the mainstream public and contributing to producing a massive flow of wealth away from the middle classes of Japan, Europe, and North America. So when a government comes in and rescues an industry or economy, it does not matter if that government is Cuba or the USSR or the UK or New Jersey or Illinois or California. Ownership has shifted from a publicly traded operation to an armed monopoly, a government. But this isn't a complaint. This is merely an observation, though perhaps excessively dramatic. Maybe not dramatic enough. Anyway, sometimes wealth and power are redistributed to more and more people, like widely distributed, more of a balanced or equal share. Other times, wealth and power are redistributed into smaller and smaller concentrations. Whether that concentration of wealth is called an empire or a ruling family or the Vatican or a cartel of drug dealers and so forth. By the way, if you think that I was making a moral condemnation when I mentioned drug dealing, you might be right. Then again, I might own quite a bit of stock in pharmaceutical companies. So just because I may be extremely hesitant to use most of their products, and I may consistently warn my friends and acquaintances about the drug companies and their constant propaganda about the alleged existence of incurable diseases, just because I may say all those warnings and all that stuff, that doesn't mean I would not ever trade in their stock. Heck, I have so little shame that I would even invest in insurance companies or government bonds. If you knew what I know about those organizations, then you know why I say so little shame. Anyway, in conclusion, beware of the mainstream media. They generally say whatever they're paid to say, or they're only paid to say the kind of things that further the interests of those paying them. That is, there's a massive systematic bias as to what gets widely published. Gold prices are going up because of inflation, and gold prices the next day are going down because of inflation. What's that remind you of? If you've read the book 1984 by George Orwell, you should recognize that pattern. The exact same cause used to explain two directly opposite effects, alleged effects. And of course, all of this presumes that there is inflation. What if there's not currency inflation or credit inflation, or not a crisis in inflation? In Brazil, maybe inflation rates have hit 6%, but 6%, is that a crisis? Really? That's a crisis? 6%? That's what the article linked at the beginning is saying. Oh, they raised it 0.5% to 6% from 5.5%. I think that's what it said. It's a crisis now. Really? Really? And Brazil's central bank, that's the explanation for gold prices dropping sharply today? Huh. And they don't mention that oil prices dropped really sharply today and yesterday. They don't mention that at all in the article. Isn't that weird? Anyway, this is not a complaint. This is merely an observation. Another observation. Some investments profit more than others. If you've been investing in the ideas and purchases that are being promoted by those who create media empires to influence you, you may experience a different set of results based on those investments than the results of those who create those empires to influence or govern the masses. So what if the media trains the masses to focus on the prospects of inflation? What if that is a strategic campaign for a specific purpose, such as the redistribution of wealth away from masses of middle classes to a select few recipients of that transfer. Now, do I have your attention yet? Let me know. My blog is linked at the bottom there, but at some point you might find that the overwhelming clarity and accuracy and controversy of the things that I mentioned, as it opposes to the what's presented in the mainstream media, you may find that the stuff that I present and the way I present it leads you to be interested in the kinds of results that are available through simple, clear perception of what's actually developing, emerging, happening as time goes on. And there, in addition to the actual investments that are available, there are lots of other issues. How people organize their finances, how people think, how people communicate and network with each other. Lots of issues. Investing is just a simple one. So, thanks for your time.